In today's video, I am going to talk to you about how you could invest $1,000 today. Now, $1,000, to some people that is a ton of money, and of course in this video I'm going to give you some safe ways that you could invest it today, and of course some more riskier ways that could have huge yielding effects onto your bank accounts. So let's check out these different paths that you could take. Okay, so the first path is of course something like a SPDR S&P 500 ETF. Now personally, if you're investing $1,000 in this ETF, you're really only going to get 2 shares, and that is something that you really might not want to do. You might want to get more shares in a company, and what you would need to then do is find an ETF that is also lower in their MER costs, like SPY, but maybe something that trades at maybe $42 a share, which then you would be able to get 20 or more shares of and get closer to that $1,000 goal. Now, the nice thing with the S&P 500 ETFs is that they will give you consistent growth over time with some downturns. Meanwhile, if you invest in something that is more riskier, you may see faster increases but also faster decreases, and you could play either side of that line. Now, if you're in Canada, you could invest in a TSX index ETF, which this one is a VCE, which is a Vanguard ETF. This one also has a very low MER rating, and it also does mirror the Canadian TSX. Of course, we got hammered during COVID, but it has recovered. But again, here you are only going to be mirroring the market. So if you're looking for a long-term growth, let's say you're 18 years old and you want to maybe retire when you're 45 and you can put lots of money into an ETF like this, you could make a lot of money. This also does pay 3.17%, which for $1,000 would get you around $31 per share every single year. And then what I would then do is just reinvest that $31. That $31 is really not going to make you, or buy you, I should say, a lot of things. So when it comes to $31, reinvest it, get more shares, even if they're fractional shares, if your trading platform allows for that, and you will be all set. Now, if you're looking for a future income opportunity, Bank of Nova Scotia, TD, any banks can give you a solid company without an MER and give you some pretty high dividends. So let's say you were able to invest $1,000 into something like BNS, that would conceivably get you around $44.30 a year, which isn't a ton of money, can't buy you a lot of things, but if you were reinvested, if your platform allows for fractional shares, then you'll be all set. And this is how I invested when I was early on. Find companies that pay a dividend so that I take it out as cash, and then I can reinvest it into other companies. Or when I turn 31 or 30, I am able to use that money as an income source forever. Something that is a little bit more risky is Tesla. It is, in my opinion, on sale right now. It has had a lot of FUD, which what they call is fear, and basically a lot of confusion around the company. And of course, the media companies, they are always going to try and fearmonger, and that is the reason why I absolutely hate watching the news right now. They are basically just clickbait. Every single newscast right now is just single clickbait. That's all it is. And when there's clickbait, especially with a stock, what's going to happen? There's a small story that the media makes big because of a headline, and then the stock goes down, and that is essentially what's happening with Tesla. Yes, there are a couple of recalls happening right now with their cars, but if you look into the future, first off, every car company has recalls. Second off, if you look into the future, we can see that they have solar panels, battery technology that they are actually starting to sell to the power grids, software to run those batteries on the power grids, which they lease out, and then they also have their cars and potentially more things coming into the future. So this is a great company for the future, and I think that this is just one of those downturns that it makes the company on sale, and it's a good time to buy. Could it drop below 500? Yes, if it drops below 500, there's going to be some issues and may drop even lower, but if it can stay above 5, something something in the 5 range or higher, then I think that it's basically on sale for the future, and you could probably see the stock go huge over the next year to 2 years. Now, if you're looking for something that can make you a ton of money over the next maybe 3 to 6 months from $1,000, look into the marijuana companies. There's some more solid companies like CGC and Aurora, and then there's more speculative companies like Sundial that can give you some massive growth because the US government is starting to look into legalization. And if they do legalize it, look at the charts of companies like CGC as well as Aurora. When the Canadian government legalized weed, look at the chart and look at the growth, the exponential growth. CGC went from like $3 a share to $20 a share, essentially like this. And that was super fast. And I was one of the many who were investing in the weed companies back when Canada was legalizing, and I'm playing it once again with the Americans legalizing it. And if they do at the federal level, I can almost assume and guess and speculate that their stock prices will do the exact same as it did when the Canadian government legalized it, which meant that the stocks went from, let's say CGC as an example, went from $3 to about $25-ish dollars, and then it sunk back down to about that 15 to 18 mark, which would have put it on sale because at that time they said, well, it's going to take 6 months to a year to get it like into stores. And then as soon as it got into stores and it was the official legalization day, too bad it wasn't on 420, but when it was legalization day, like CGC went stupid. It's still going crazy. Really, if you think about it, it's way past the $3 mark if I decided to not sell all my shares at 20. But I held it. With CGC, I had it at just a high $1, $1.80, $1.90 somewhere, I think it was. Maybe low $2, and then I sold it at 5, got back in at 3, sold it at 11, got back in at 5, and then sold it again at 20. If you can do trades like that, then you're all set. But ways to trade like that is like this. If you put $1,000 into a stock, and it on a casino stock, and it doubles, what you do then is you sell half. When you sell half, you make your $1,000 back, and you still have $1,000 riding on that stock. That way, if it doubles again, then you can take another 1,000 out, and then you've still got 1,000 riding on it. And then every single time it goes back down to close to where you originally purchased it, or it comes down to a point where you feel like it's a good investment again, then you can put another $1,000 in, and you can keep on riding that train forever. So for example, Sundial is currently sitting at $1.09 per share. If you were to put $1,000 into it, and then it went to $2.18 a share, which if we look at the 6-month chart, we can see that it got up pretty high. That was the initial jump. If we can get back in now, which I have been, and then we can accelerate it back out, then we are all set. But Sundial is a very, very risky company to invest in because they are currently making less money than what they are spending. So definitely invest in stronger companies if you feel like you cannot lose $1,000. And that is another message for today, is if you cannot afford to lose $1,000, then do not risk it on a casino stock trade. Make sure that you invest that money in something that will slowly appreciate over time, because if you turned around tomorrow and said, oh crap, I need to buy tires, or oh crap, I need to buy something, and then you turn around and say, well, I got this $1,000 worth of stock, and you look at it and Sundial's gone from $1.09 to 60 cents. You now don't have $1,000. You now have probably $570, and that will no longer buy tires or whatever, maybe that medical emergency or whatever it is happens. So invest what you can afford to lose in risky stocks, and then invest into stocks that are strong and ETFs that are strong if you can't afford to lose the money but you can afford for it to be a bit riskier, that it can be sitting there, and if it goes down 5%, it's not going to hurt you as much as if a stock went down 50%. I hope that this video has given you some insight onto a couple of stocks to check out. I hope that you've enjoyed. I'll see you guys again next time.